Welcome to The Explainer. Today, we're going to pull back the curtain on one of the most powerful but honestly pretty misunderstood forces in our economy: interest rates. I mean, they affect everything: your mortgage, the stock market, you name it. But how does that number actually get decided?
So, who actually decides what you pay on your credit card or student loan? It might feel totally random, right? But it's not. It's actually the end result of a very deliberate process. And that whole process, it all starts in one place: a country's central bank. For us in the US, that's the Federal Reserve.
All right, so to really get how interest rates are set, we have to start with a choice. A choice that every single one of us makes, probably without even thinking about it. And that is, how do we hold our wealth? It sounds kind of complex, but really it just boils down to two main options. Okay, think about it. On one hand, you've got money, actual cash, or the money in your checking account. It's awesome for buying stuff, right? But it just sits there, earning you zero, zip, nada. Then, on the other hand, you've got things like bonds. Now, you can't exactly use a bond to buy your morning coffee, but they pay you interest. That means your money is actually working for you. It's growing. And that's the trade-off we're all constantly making. So, see, your desire to hold cash isn't just some random thing. It really comes down to two big factors. First, how much you spend. Simple enough, right? The more you buy, the more cash you need on hand. But second, and this is crucial, it's the interest rate on bonds. I mean, if bonds are paying out a ton of interest, let's say 10%, you're going to be way more tempted to stash your money there instead of letting it sit in a checking account doing nothing. Okay, so that's the demand side. It's all about us and our choices. But that's only half the story. Now we've got to look at the other side of the equation, the money supply. And this is where things get really interesting. See, while our demand for money is all over the place, the supply, well, that's controlled by one single entity, the central bank. They're the ones who decide exactly how much money, let's just call it M, is out there in the economy. So what's the interest rate then? Well, you can think of it as the price of money. It's the magic number where the amount of money we want to hold, that's the demand, perfectly matches the amount of money the central bank has put out there, the supply. When those two lines cross, bam, that's your interest rate. Okay, so we know the interest rate is where supply meets demand. But how does a central bank actually, change the supply to get the rate they want? This is where the real action happens, and honestly, it's pretty brilliant. So how do they do it? You might be picturing them just firing up the printing presses, right? Or maybe dropping cash from helicopters. Nope, it's way more subtle and way more powerful. They use a tool called open market operations. Let's say the central bank wants to lower interest rates. To do that, they need more money in the system. So what do? They go out into the market and they buy bonds from banks. The banks hand over the bonds, and the central bank hands over brand new money. It's like they're turning on a faucet and pouring cash right into the financial system. And what if they want to raise rates? You guessed it, they do the exact opposite. This time, the central bank sells bonds to the banks. The banks buy these bonds with their cash, and that cash gets pulled out of the system. So now they're soaking up the money, which shrinks the overall money supply. And this whole process reveals a super important fundamental rule in finance. It's a big one. When the central bank is buying up tons of bonds, that extra demand drives up the price of those bonds. And here's the kicker. When a bond's price goes up, its interest rate goes down. They're like a seesaw. One goes up, the other has to go down, always. Just take a look at this. It shows you exactly what I'm talking about. Let's say you've got a bond that'll pay you $100 in the future. If you buy it today for $95, your interest rate, your return, is about 5.3%. Not bad. But what if you could buy that same bond for just $90? Well, now your return jumps all the way to over 11%. See? The less you pay upfront, the higher your interest rate is. All right, so we've got the central bank on one side and all of us on the other. But we're missing a key piece of the puzzle here, the middleman, and that's the commercial banks. Right, so the Fed isn't calling you or me up to buy our bonds. They don't deal with the public directly. They work exclusively with commercial banks. You can think of them as the financial intermediaries, the go-betweens, that connect the central bank's actions to the rest of us. This whole thing creates sort of a two-tiered money system. So here's the breakdown. Step 1, the central bank creates this special kind of money, often called reserves. Step 2, the commercial banks, your bank, hold these reserves. And then step 3, the money we actually use, the money in our checking accounts, is held at those commercial banks. And those deposits are backed by the reserves. So the money the Fed creates is like this high-powered foundation for the entire banking system. Okay, so next time you're watching the news and you hear something like, the Fed is changing interest rates, this is the rate they're talking about, the federal funds rate. It's literally the interest rate that banks charge each other to borrow those reserves we just talked about, usually just overnight. And by nudging this one specific rate up or down, the Fed creates a ripple effect that influences pretty much every other interest rate in the economy.
Okay, this system is incredibly powerful. It's designed to steer the entire economy. But what happens when it just stops working? What happens when it hits a brick wall?
I mean, think about it. Can an interest rate actually go below zero? In the real world, not really. Why would you ever lend someone $100 if you knew you were only going to get 99 back? You wouldn't. You just hold on to your cash. And that floor, that absolute bottom, is what economists call the zero lower bound. And when interest rates slam into that 0% floor, the economy can get stuck in something called a liquidity trap. And it makes perfect sense when you think about it. At 0% interest, a bond pays you the same as cash. Nothing. So why bother with the bond? You become totally indifferent. You might as well just hold on to cash, because at least you can use that to buy things. And the consequence of this is huge. It basically means the central bank's main weapon in its arsenal just stops working. It becomes useless. They can keep pushing more and more money into the financial system, but it doesn't do anything to interest rates because they're already at zero. They can't push them any lower. Their number one tool is suddenly off the table.
And listen, this is not just some dusty old textbook theory. We've seen this happen. Major economies all over the world have hit this zero lower bound in recent years, and it's forced central banks to get really, really creative. It leaves all of us with a massive question, not just for the experts, but for everyone. When your most powerful economic tool is suddenly gone, what do you do next? How do you keep the engine running?